Welcome, everybody. This is Louise, and I'm glad that you are joining us today for the O'Neill Marketing Summer of Training webinar series. We are taking time this summer to become familiar with various insurance types and carriers. Today, NatGen will talk to us about their group insurance, and next week we will have 2 Medicare webinars. Later this summer, we will have ancillary and ACA webinars. We trust that the more you educate yourself, the more successful you can be as you understand product types and features. So today we are excited to welcome Sid Clark as we explore benefits that employers and their employees can expect from NatGen. And today, as we listen to the presentation, we encourage you to please type in any questions that you have, and after the presentation, Sid will go through those. So take it away, Sid, and glad you're here with us today.
Thank you. Thanks for having us. We're excited to get educated individuals out there on National General benefit solutions, because I'm a firm believer as well that health insurance is one of the undereducated markets, and it gives us all a job because we all get to educate the masses to uncomplicate the complicated and allow to offer value as an advisor. So my goal today is to basically unpeel the layers of the onion of what health insurance, what National General is doing as an alternative in the space to really differentiate yourself from the competition. A group lead or a group health insurance prospect or an employer is not only just a lead for group health, but it's also a lead for group ancillary lines, individual sales, contacts. So getting in with an employer should be every broker's dream, that they are able to uncover countless leads from that point on. So here at National General, we've built programs that have allowed you to have a different conversation with a client as an alternative to kind of what we call the BUCA carriers, the big names, the household names. National General brings an alternative to the space that's simple to understand, allows you to get money back in certain circumstances, but keeps everything acting, feeling, and look just like something that you're used to selling, a major medical benefit. So without further ado, I kind of get into it. Again, please encourage the Q&A. We'd love to answer any and all questions. There are no bad questions. Somebody's thinking the same thing you are. Just put it down on paper so we can all get the answer. And with that, there's 2 types of really major group insurance that is out in the marketplace. There are fully insured contracts, which are guaranteed issue, typically spreadsheetable, where you just put a price and an age and a group on paper and that's your rate. And then there's something on the other end of the spectrum, which is called level funded, self-funded, alternate funded. There's a bunch of cute names for it. It's all governed federally under the law of ERISA, which makes it ACA compliant, 100% meets the minimal essential coverages. And really a major medical program that an employer can build to give their members a program that acts, feels, and looks like a regular health insurance plan, but gives them the ability to really cater to their needs. So it's a lot more flexible in plan designs. It's a lot more flexible in requirements on participation and contribution. So our job is to be the alternative into the space, not the one size fits all, but allow you to have that conversation with everyone, to offer your value to the employer enough to get either an AOR or their information to write other lines, or hopefully the medical. So my big point that I want to start out with is the 3 components of what the difference between the 2 different types of insurance are. You have the fully insured. If you just want to take those bar graphs on the right and think of them as a $1 bill, the fully insured market has $1 of premium that's paid, and the insurance carrier takes on the risk for that dollar in exchange. What self-funding does is it takes that same dollar and hopefully takes off about 10 to 20% off the top for an immediate savings impact. Once you have that savings potential, you take the other 80% or whatever's remaining on that dollar, and we, the carrier, not the employer, so it's not complicated, we, the employer, are putting it in 3 separate parts of the contract, so that we are transparent with where your money's going. You know you're getting what you're paid for, and if you end up running as expected or better, you have a good claims year, you're going to see a potential refund come back to you. So at a very high level, and the points that you would want to get across to your business owner when you have a pitch with them, first get it quoted so you can identify the savings, and then you can do a high level explanation of what the alternative is. Again, the program to the member, the user of the insurance, is going to have a deductible, it's going to have an out-of-pocket max, it's going to have co-pays for your primary care visit, your specialist visit, your urgent care visit, telemedicine, etc. It's going to act, feel, and look like health insurance. The big deal is we're taking that dollar and we're just putting it into 3 different buckets, so the business owner knows what they're paying for. The big bucket up top, stop loss premium, what that does is it essentially protects any size business from having a financial exposure different from what fully insured offers, where they pay their monthly premium and they have insurance. That's what you have to pay for with our program. It's built into the premium. We take that dollar that we receive and we push a portion of it towards stop loss premium. We were recently acquired by Allstate, so now we're an Allstate company, more of a household name for you all to tout. It makes us an A+ rated carrier. You're going to have the protection you need in the event claims get out of hand and you have a really high claim year. You're not going to pay a penny more than what your monthly bill is, just like a fully insured equivalent premium. The next bucket is the cost of doing business. In order for it to act, feel, and look like a regular major medical plan, you have to have a network, or you have to have some sort of a pricing strategy to pay the providers. You have to have a TPA, a third-party administrator, somebody there to actually process the claims, pick up the phone, verify eligibility, help somebody with a claim. You need a pharmacy. You need somewhere to pick up your prescriptions, a pharmacy vendor. Commissions are built into this. Anything that kind of keeps the light on and the program running, the cost of doing business is built into the admin cost. And then the biggest differentiator is that we're actually setting aside a chunk of the dollar for the group, specifically for how they're expected to run from a claims perspective. So we're taking a dollar amount, setting it aside, and putting it in a bucket to basically pay claims with on the employer's behalf. So again, not an extra administrative piece, not anything that the business has to be involved in. They can be aware of what they're spending and what they're not spending, but there's zero responsibility to do that. We handle everything on the back end. But what it does is it gives that group a stack of money for us to use on their behalf. And it includes Runout, so they don't have any lagging claims. All of our contracts have a 2-year extra tail on it for any delayed claims that get audited. So it's a very safe, all-encompassing contract that acts, feels, and looks like the one on the left, but you get savings and you get a refund potential. That claims funding bucket that we're setting aside for that year, if there's any dollars left over in that, the business gets a check back from us after a set amount of time. So they can actually pay for insurance, not use it, and get money back. That's what all insurance should do. This one actually doesn't. So very simple. It's just a high level breakdown of the, again, what is in the market. Fully insured, self-funded, or level funded, or alternate funded. That's what's out there right now for you guys. It's been out there for a while. We do a very good job at it. We've been doing it for about 15 years, pre-ACA, and we have a ton of options. So before I get into that, how we simply explain that to a business owner is you're going to get a quote, and on that quote, plan one's going to have a $1,500 deductible, 6,000 out of pocket, whatever you need from a benefits side. Tell me what your deductible you're looking for. Tell me the out of pocket. Tell me the co-pays. Tell me if you want an HSA plan. We'll build that plan, and say that plan in your head is plan 1. What it's going to do is it's going to illustrate a 4-tier composite rate. So you're going to see the employee spouse, the employee child or children. You're going to see the family rate illustrated on a set dollar amount, that our goal is to lock those 4-tier rates in for a year and give you a 4-tier rate that you can bank on regardless of what you hire or fire during the entire policy. That's where it comes into the level funded, right? You know what you're going to pay. We take the census, times it by the 4-tier rates, and at the bottom where it says total, that's your total premium. That's really all a business should be concerned about. How much am I going to pay for health insurance? And how do I know how much I'm going to pay when I hire somebody or fire somebody, how much it's going to come off the bill? That's how the program works during the 12-month policy. You have your 4-tier rates times the census. In this example, it's $9,000 a month. We're going to illustrate that on every single proposal to let you have that education piece with every business owner to earn credibility, to earn the advisor role for them. And that's just going to show them that we have stop loss premium being funded, admin, sales, and general expenses, claims account funding. That claims account is obviously going to aggregate throughout the year. It's going to build up over the year for 12 months. So that number times 12 is always going to show up at the top under what's called the annual aggregate limit. That's the claims bucket for the year. And what you can actually say, the 39,882 at the top, you can say 75% of the groups that go with National General are receiving some sort of a refund, and most of them are seeing about 10% of that number. So what we're doing in this space is offering a savings up front and then about a 10% on that number of 39,000. So this example, about $4,000 the group should get back. It's a case-by-case example, but that's the national average. That will pay you back. And we're not reinventing the wheel. Your members are still going to act, feel, and look like they have a program that they're used to. So it's great for virgin groups. It's great for replacement groups. It's a great conversation to have, even with a group that may not qualify for it. We're going to get into a little bit more detail on that here in a second. Before I move on, I'm just going to go ahead and actually move on. Our wheelhouse has always been the small group space. In the last 2 years, we've been moving upstream in the 51 plus market. So really our solutions are national. We're filed in 49 of the 50 states. We're not in Hawaii. Unfortunately, I would love to do employer events in Hawaii, but we're just not there. So 49 of the 50 states, we do have a product filed. Our main target nationally is anywhere from 2 to 350, so should be a pretty big bucket for you guys to fish in. We offer national and regional networks depending on where the group is situs. Our main contracts are with Aetna and Cigna. They're all national networks. Cigna Local Plus is a regional PPO. Cigna OAP is their biggest open access plus network. And then Aetna Point of Service 2, you're probably familiar with. Aetna ASA is just another national PPO that we're competitive with in parts of the country. That's specifically a rental network that's equal, right around the same size as the POS2. In addition to that, we're going to be one of the major carriers that you can reach out to that is very successful in what's called reference-based pricing. Reference-based pricing, you can Google. I would encourage you to Google reference-based pricing, educate yourself, contact us for a high-level overview of it, quote a group and look at the price differential with it. It is a transparent pricing model that does not take network discounts into consideration. It actually reprices claims off of a multitude of Medicare. So whatever Medicare we're paying well above and beyond what Medicare would pay for the same exact service at the same exact facility. We're just going to reimburse 50% more than what those carriers or what Medicare pays. So it's a very successful product. It takes a little bit of education and the right fit for a group to experience a price savings and also and have a good experience with it. But we have it in our toolkit. So again, it's another education piece you can bring to your clients and to your employers that most people, this is the new wave. Level funding came about 6 years ago. Reference-based pricing is definitely on the come up. So getting out and getting this conversation with somebody early is going to show value. I'm happy to, do another one of these down the road when education continues with O'Neill Marketing. But I'm just going to leave it at a high level for now. The big takeaway here is that 2 to 350. If you have a group in that size, let's quote something. Reach out to O'Neill Marketing, get your quote from us. Let's have a conversation and deep dive into a little bit more of an education on a case-by-case basis. We want to treat each client specifically for their needs. So if you have any other questions, again, contact information will be released or put it in the Q&A. This is just a heat map for us as a carrier. Historically speaking, red states is where we sell the bulk of our business. Green states are up and coming, and there's definitely big pockets of strength within those states. And then blue is more of a challenging market that either has state regulation that make this stop loss product or this level funded product harder to sell to the small group. As you can see, North Dakota requires 50 eligible. There's not many employers 50 eligible in North Dakota. New York is 100 eligible. We do have business in there. There's pockets of strength there. Rhode Island, same thing. DC, 50 plus. So they kind of kick us out of the small group space. But for the most of the states here, Florida, my hometown, we're very aggressive in that 5 enrolled minimum. We need a little bit of meat on the bone to 50 for the small group space, and then 51 plus, we're growing in that segment as well. So anything red, definitely get it quoted. Have an initial conversation before you talk to your group with us, and we'll get you on the right path to either have a quality conversation or hopefully write you a group. Basic qualifications, you still need employer contribution and you still need participation in order to offer an employer-sponsored plan. So the employer basically has to be invested in contributing 50% of the lowest cost plan offered of the employee-only rate. So a very small contribution minimum. I don't like to go after the minimum. I like to get as much of the employer's buy-in because it's going to help with retention. It's going to help with employee being satisfied, and it's going to basically keep employees happy. So I think the less they have to spend on health insurance, the better the company is in general. So, but there is a minimum 50% of the employee-only rate. Participation requirements, just rule of thumb, is 50% of the total eligible population or 75% after valid waivers. It's an either or. You meet one, great, don't worry about the other. A valid waiver is anything that is other insurance. So as long as they have something else, they just have to check a box that says individual, spouse, TRICARE, other, write in what they have. That's a valid waiver. The only thing that's not is a cost. I just don't want it because I don't have it. That's obviously a possibility, but we still allow for 25% of the population to be that and the other population to be valid, and you can write the group. So basic participation requirements, there's a ton of flexibility, which is my next slide. We don't lose groups to participation too often. There's hours of flexibility that you can make a requirement in the under 50 space of a 10 life group that you must work 40 hours, despite what the state says. You must work 40 hours to be benefit eligible with this program. So you can actually have an ACA compliant plan that only is offered to groups with 40 plus hours. Those 30 to 40 would not qualify, and maybe you meet participation that way. So a lot of flexibility and a lot of things that we can do, including carve-outs. But the big value and the takeaway from an employer, and the ones that are going to buy health insurance from you, are going to be those that value employee retention, want to know about tax benefits for the employer for offering group benefits, or that Section 125 POP for the employees for pre-tax contributions, and basically keeping your employees healthy overall. You get to control the narrative with wellness, with telemedicine, and encourage healthy habits once you put an employee benefit plan in place. So flexible, this may be a little small here, but this despite all the differentiators that I've already mentioned, all the networks, Allstate name, level funding being a refund, and allowing for groups, we can do virgin and startups. So they don't even have, we've written a group this last month that started on 7/1. They had signed W-4s for their W-2 employees. They had an articles of incorporation, and we issued the case. So virgin groups and startups, as long as you can prove to me on paper that there's an employer-employee relationship where that employer is paying those employees, we can typically write the group. The hour requirement for eligibility, again, this is under 50 eligible, under 50 full-time equivalents. You can flex that hours from 20 to 40 to offer it to everybody that works 20 hours or more, or 40 hours. So whatever the employee's app says is how we're going to check on that. And that'll help you maybe meet or have a conversation with an employer that isn't ready to commit everybody that works 30 hours, but wants to take care of the full-time people that are working 40 hours plus. Again, more lenient participation. We go as low on our reference-based pricing program to 25% of eligible or 50% after removing valid waivers. So again, another flexibility that we have within our portfolio of programs that can help you win a group or give a group health insurance. 1099s, this is one of the biggest differentiators with us. We can make them eligible and treat them like W-2s. So if an employer has a bunch of 1099s and they want to offer health insurance, they can include them in, and we're going to treat them like a W-2. So there still needs to be a minimum contribution commitment to them, and we're going to not discriminate against any 1099. So as long as they meet the definition of what a W-2 is, they're working full-time hours and they work for the company, we can include the 1099s based on just providing a 1099 from that company. Carve-outs can be done. So management versus non-management, a very common carve-out. Location, if you have one location in Florida and the rest of the country has a couple of locations and we only want to write the Florida case, we can do a location carve-out. We can do a tax ID carve-out, warehouse, job description carve-out. So warehouse workers versus office staff, salary versus hourly. We're still doing carve-outs in the under 50 space very often that help us win groups. Plan flexibility, no off-the-shelf plan. So I'm building everything a la carte. I want to keep it in a dialed-in conversation that you want to have. So if you know you need a $3,000 deductible and that's all we're going to try to show, we're going to quote one plan, have a conversation, and then obviously listen to the employer and tweak plan designs from there and get their commitment to move forward with us. So you can mix and match and create different solutions, everything from deductible, out-of-pocket max, co-insurance, co-pays, RX, etc. That is all going to be flexible with us. So no really off-the-shelf plans. Again, I'm not sending you a PDF with 300 plans for you to pick the best one. We're not a spreadsheet company. We are a conversation company. We want to give you a marketing piece, which is our rates on paper for that business with a targeted approach to help you find a solution for them. So as far as what we need to quote in the under 50 market, it's very simple stuff to get the process started. Now, you guys can all see the screen. This is all easy stuff. I don't need to read it. But when we get the marketing piece, which is our rates on paper, the initial proposal is not set in stone. We are not a guaranteed issue product. We are what's called a health underwritten product. So level funded is going to be that way, and it all depends on how you underwrite. Many carriers will do many different things. How we do our underwriting, once you get your proposal, you set the expectation, you have number 4 is huge. Hey, do you know of anything that you're aware of from a health front? A lot of small businesses will know, despite them saying, I don't want to know, they know. We don't want to waste anyone's time. If you can get this information and you can pass this information along to us, we will do our best to not waste your time and their time and tell you what impacts a health condition can have to a quote before you make the employer do anything. So 10 life case, type 1 diabetic, and a pregnancy, that comes in on an RFP to us. We quote it, we build that rating in there, and we tell you where we're at with a type 1 diabetic and a pregnancy. You're not going to always have that information, but it's great practice to ask that question just to make sure you're doing your due diligence and getting the employer's buy-in early, that when you come back with a quote, they already know, hey, I feel like I'm healthier than the average group. Hey, I don't think there's any major health concerns going on, and I should go through this process, this underwriting process, to put something in place that's going to save me money, save my employees money, and basically act, feel, and look like a health insurance plan that I'm used to, with the potential of a refund. Hopefully upgrading the networks and upgrading the benefits at the same time. So this is basic information. I'm sure you all can get it. If there's any questions on this, please put it in the Q&A, and I'm happy to answer it. From this step forward, I don't have a slide on this, but I can absolutely share a link with you guys. What we would do is present the proposal, show the rates, ask the employer if we can get any rates close to this, would you guys move forward? You get that commitment, you have them ask their employees to click on a link, fill out a profile which asks health information on it, similar to like a intake form at a new hospital or a new primary care, similar to a dentist office questionnaire, life insurance exam without the actual blood draw. So just a lot of yes or no questions, and then provide some detail for those yes. It's all online. It comes directly to us, and we accept many different forms, different electronic platforms to collect. We can pass along that information for you. But once you get the employer's buy-in to try to achieve savings and go into a level funded program to get a refund, you have the employee base. Those that are enrolling do what I just said. Those that are waiving are simply waiving coverage. The typical employee only takes about 5 to 10 minutes to complete this online form. I'll pass along the link to you. You can create your profile as you see fit. You don't have to obviously fill out your own information. You can make some stuff up just to test out the system. But I would highly encourage you to do that so you can speak to how simple and easy the online link is. So you have 10 people, 8 people want it, 8 people fill out an enrollment form online that answers medical questions, 2 people waive. We send it to underwriting. You're gonna have underwritten rates in about 48 hours, even at peak season, 48 hours. Sometimes we'll get to 72. So you wanna touch base in the peak of fourth quarter and set the expectation. I'm gonna get back to you in about 3 days. We can have that conversation and get the commitment to move forward at that point. So everything you send to us should be about a 24 to 48 hour turnaround time. This is the only way that you're going to sell this program, is if you get the group's name, the dates of birth, you put some savings on paper, and you have that conversation that I illustrated earlier about the savings, acts, feels, and looks like fully insured, puts you in a position to get a refund. And there's a ton of different flexibility and options with this carrier. And oh yeah, it's all state backed, A+ rated, quality stuff here. Worst case scenarios, I educated on it, and we know where your group is if there is some risk that comes through. So you've taken inventory on your group to see if it is a good fit. That's your worst case scenario. Every employer should want to do this because it's for their best benefit to qualify for something like this, for savings, refund potential, and again, upgrading network and benefits, hopefully. So again, please put any questions in the chat. The other options, because we did get bought by Allstate, we have full access to what they call their SMS lines, voluntary benefits. They have a slew of packaged products that are all guaranteed issued, down to 3 applications per product line. And you can offer up to 3 as long as you get 6 applications. This is all voluntary benefits, so paid for by the employee. In addition to that, we're offering dental, vision, life, CI, and much more. So one-stop shop from us to be able to get whatever you need. You may or may not need all of these, but they're available to you, and that's a value that a lot of carriers can't offer right now. And one of the most exciting parts about being backed by Allstate outside of their household name. So I teed this thing up to kind of be 30 minutes, action-packed, leave plenty of time for Q&A. Hopefully The rep that you guys are going to work with, again, my name's Sid Clark. I'm the district sales manager for Florida. Anybody that works through O'Neill Marketing, since they are headquartered in Florida, will come through our office. The assigned small group rep for you guys, his name is Austin Young. Very good guy, loves golf. He's actually upset that he had to miss today, but wants to engage with anybody that has interest immediately. Have a phone call, have 15 minutes set aside, talk you through, educate you on reference-based pricing. Really, whatever you need to get comfortable and to feel comfortable is what needs to happen, and he's willing to spend the time to do so, in addition to me as a backup. So his contact information's here. I'll pass along, we will pass along through O'Neill Marketing this slide deck along with my contact information as well, so that you guys have basically what you need to get started and start reaching out to O'Neill for quotes. Again, 24 to 48 hour turnaround times, and it's a positive conversation that you can have with every small group, and position it that if you can qualify for it, it is a no-brainer, and obviously reap the rewards of writing quality business and hopefully, you know, coming through as an advisor to your clients. So without anything else, if there's any other questions, comments, I'm going to start looking through the Q&A. Feel free to speak up now, and we'll go from there. All right, some great questions in here. There's 4 of them. Oh, I'm getting some feedback. Does somebody have a question? Nope. Okay, so we have, how long does an employer have to wait for the refund? On all of our proposals, there'll be something called a runout period. A runout period varies from 6 months to 12 months. That's the amount of time after the contract that we have to wait for lagging claims to come in, and then we start the process of the refund. The refund process takes about 3 months. So what I always pitch, depending on what my runout says, is the runout period says it's 6 months. I say you'll have a check in hand before the end of the ninth month. Check in hand at the end of the next year. Check in hand again. We pay a check back regardless if they renew or not. So that's a huge differentiator between any other competitor in the space. We give their money back regardless if they renew, even if they have to leave this program for a fully insured after year 1, year 2, year 3, whenever. If they do leave us, they still get the check back. It is a check to the business. It is not a credit on future invoices. It's a cut and check about 3 months after the runout. So great question. Really appreciate that question. How does shop fit into this? Chuck, you guys want to handle that? I don't see how shop fits into this outside of maybe them on shop and it being a valid waiver to me. But if you guys want to speak to that really quick.
I don't. I'm good.
Okay, no worries. So shop, in my opinion, doesn't really fit into this outside of if an employee has a shop plan, ACA plan, it's a valid waiver for us. They wouldn't be on our plan. So we can, if you want to elaborate, maybe I can help out a little bit. Another spec and ag question, that's why I pulled up this slide. Every program that we write, or most of them, we do have a spec only program in certain states, but every program has what's called a group claims limit and a specific claim limit, and not a limit as far as how much we're going to pay, but more of a, hey, I don't want my entire claims bucket to be drawn down by one big claimant. So in this example here, the specific limit is set at $20,000, And we have many different options. We have anything down from 6,500 to 100K specs, specific limits. In this example, if you have a $100,000 claim from one belly button on the plan, that claim is only going to draw $20,000 from the claims bucket, and you're going to have $19,000 for the rest of the group. So really what it is a protector of the claims bucket. What you're doing in the small group market, they don't really matter. So what we try to do is quote the highest specific limit possible, because in the small group market, when you're writing groups with level funding, traditionally they'll be underutilizers, and with smaller claims buckets and with the cost of health insurance, if you have one catastrophic claim, you're probably going to be losing your refund based on utilization. Now, we have people that have one catastrophic claim and get big checks back, but in the event that a 20,000 spec hits and you only have 19,000 for the rest of the year when you were planning on 40, the refund's probably going to go away anyway. That doesn't mean we're going to kill you on renewal if it was a complicated pregnancy, for example, that hit. You know, and the baby and the mom are fine. We're not rating for making up on lost utilization. We're rating for what we expect moving forward. So we're going to put out a renewal that would reflect that. So if mom, baby healthy, the risk is gone, you're not going to see an increase. You may not see a refund, but you're not going to see an increase in that example. So that's another great question. It's somewhat of a moot point. You do get the question off, but I always pretty much try to shy away from it because it does not matter. If you put a lower spec, it makes the premium higher. So why would you pay more money to protect a potential refund that you're not guaranteed to get anyway? Although 75% are getting one, and most of those cases have the highest spec possible. So I recommend the highest spec always, and basically downplaying the importance of it in any way, shape, or form in the small group market. Checking providers, that's a great question. On every quote that you get, if it's with Cigna, if it's with Aetna, Local Plus, PHCS, anything that has a network, you're going to have a network link within the benefit description. We also have the ability to send that to you, say, hey, I want the provider list in this zip code. I mean, the websites that Aetna and Cigna and PHCS have for these network searches, it's their websites that we just direct you to if we're utilizing their network. The balance bill claims handling. So balance billing is obviously something that can happen with out-of-network claims with a network attached to the program. So if you go out of network and the provider wants $3,000, but we only priced it at $2,000, they can charge the member $1,000, a balance bill, above and beyond of what was reimbursed and the provider feels like they still need. How we handle it with our reference-based pricing program is we have two things. One is Healthcare Blue Book. We encourage the members to use. Healthcare Blue Book is a search for shoppable procedures. So I need to go get a hip replacement. Where can I go? Type that hip replacement in, zip code, and you'll have every single facility within 100 miles that can do a hip replacement. And then what it's going to give you is not in-network providers, but what it's going to give you is low-cost, high-quality providers in a very easy-to-read format. So it's going to rank every single person that can do a hip surgery within 100 miles, and it's going to tell you if their outcomes are green, better than average, yellow, average, or red, worse than average. Outcomes, data analytics, stuff that actually matters when it comes to seeing how good these people are at doing these procedures. So think mortality rate, readmission rate, etc. That data crunched into an easy to read format on quality, ranks hip surgeries, and they give you a transparent rating on quality. Then cost. Cost, again, lower than average, average, and higher than average, green, yellow, red. Easy to read format. You hit hip surgery. What you want to preach to your members is go to a green provider. Green, right? Use Healthcare Blue Book, green. It has a very strong correlation to reference-based pricing and not getting balance billed. But Obviously, balance billing is the thing that you'll see when you Google reference-based pricing and educate yourself. It's the scariest thing. How we handle it is we actually don't make the responsibility fall on the member. So the member will get a bill, because when you balance bill somebody, you're not balance billing the insurance company, you're not balance billing the insurance agent or the agency, you're balance billing the person. So the communication has to basically get out to the members. If you get a bill in the mail that it doesn't look right, if it's higher than what your EOB says, if it looks like a balance bill, if it's a huge amount of money, don't worry. Call what's called the member advocacy team. In addition to Healthcare Blue Book, we have the member advocacy team. That is their design built for reference-based pricing program. And the reference-based pricing program, their only responsibility when they get a balance bill is to call the member advocacy team, basically identify that it's a balance bill, and then communicate that balance bill or get the invoice in to the MAP team. Then the MAP team will go and negotiate it on their behalf and come to a resolution. Most of the balance bills are taking anywhere from 30 to 60 days to get resolved. And when I say resolved, I mean paid in full and or negotiated down, and a letter sent out to the member that says this is resolved. 30 to 60 days. A bulk of them get handled way quicker than that. That's the expectation that you should set. Now, a balance bill can obviously linger and linger and linger. If that happens, the member's still not going to be responsible for it. If they ever get a collection notice, they need to notify us on that. But we have resolved 100% of balance bills with the entire program of reference-based pricing over the last 4, going on 5-year history. 500,000 claims have gone through the system. About 4% of those claims are actually balance bills. So it's not a majority of the claims. It's really a small percentage of them. 4% of 500,000 have been balance billed, and we've resolved every single one of them without a member paying a penny more than what their EOB said. So that's huge. That extra money comes from the aggregate limit or your potential refund, and then stop loss, and that's actually in our contract. So it's a very strong and member-focused program, reference-based pricing, and why we've had such tremendous success with it. That's a lot of education to answer that one question, and we would love to engage with you on those conversations if you're interested in it. If you read an article on it and you have any other questions on it, please let us know. So that is 1, 2, 3 questions, 4 questions. Can we discuss network? Again, network, national PPOs, Cigna and Aetna. Network is not a conversation. If we find or need a network with us, we're traditionally competitive on a national network scale versus an HMO on the fully insured side of things. So network should be touted in these programs and highly encouraged to use. Definition of self-insured, that essentially is basically saying, if you go back to the slide here where you have the dollar on the left, fully insured, if you replicate these as dollars, fully insured, you're giving the insurance company $1 and they are transferring the risk from the employer to the insurance company. With self-funding, the risk resides on the entity, the employer, for paying for claims. What we've done is simplified self-funding, and we've made it so that an employer only responsibility is to pay their monthly invoice for 12 months. As long as they pay their monthly invoice for 12 months, they're going to have a contract in place that they're not going to pay a penny more than their health insurance premiums. But what's actually helping, and why it's called self-funding, is because those dollars are being set aside to actually be used on the employer's behalf to pay claims. So they're essentially self-funding these groups. That's a great question. It is the 2 different types of products in the market that are ACA compliant. There's different carriers doing both, fully insured, traditional, guaranteed issue, spreadsheet type of a program. If you're interested in only showing those options, we are not the solution for you. Self-funding, that's what we do. That's what we love to do. That's what we want to do. That's what we are here to do, and we're making it as simple and as easy for any small business to do that with very limited risk, if any risk, as long as they pay their monthly bill. I already answered the spec question. But long story short, depends on how much the claim is. If a claim happens and it's $100,000, the claims account is going to be drained by whatever the spec is. So say it's $20,000. And then the rest of that claim, the $100,000 claim, is going to be covered by stop loss insurance. So the member's not going to be out of pocket for it. Still unlimited max payout from a stop loss carrier for claims. There's not a claim that can happen where we can't pay it, being an A+ rated carrier. The pharmacy, great question. I didn't say which the pharmacy was. The pharmacy is Cigna PBM right now. That probably is going to stay in the small group market for a while. It is a national PBM. It's in all your box stores. It's called the Advantage 3-tier on the Cigna formulary. We can give you that information on a group by group basis. It has a whole formulary with generic, brand, non-preferred brand, and then specialty. Specialty is deductible and coinsurance. So you have copays for the first three, and then specialty, like injectables, things of that nature are going to be deductible and coinsurance running underneath the medical portion of the plan. I think, let me see if I got any more here. Is there anything I missed, guys, that you're aware of? I think I answered most of the questions that were in the Q&A.
You did a great job, Sid. Thank you so much. You're very articulate.
I try in these situations. It's very hard to hear, and it's very hard to stay focused when you're in front of a screen and just staring at one person talk for 45 minutes. So I try my best, and I really appreciate every single one of you guys jumping on and continuing the commitment to education in the healthcare space. We need it. We need a lot of it. And we need people like you to keep making sure these employers know what the heck they're doing. So thank you all so much for the time and efforts. And I'll make sure to get you guys my contact information in this presentation so you can send it out to all the attendees and those that were unfortunate not to make it. So thank you. Thank everybody.
Thank you. And I just want to let everyone know that we appreciate all of you agents joining us today. And hopefully this was empowering and encouraging for you to get out and look for some group prospects. Please be on the lookout for a summary email that will be sent out to all of you today. And if you are not a current agent with O'Neill Marketing and would like to sign up to work with us, we'd love to talk to you more. If you are a current agent and would like to get the NatGen appointment, please fill out the appointment request form so we can get that processed for you. Thanks again for joining. Our next webinar will be next Tuesday, July 13th with WellCare, a Medicare provider. And that webinar will also be at 11 a.m. Eastern Standard Time. Thank you so much and have a great day. Bye-bye.
Thanks, everybody. Bye.
Thanks, everybody. Bye-bye.